Long story short, the stock market continues to bounce up. In mixed markets today, we're seeing the NASDAQ down, the other indexes are up a little bit. But overall, when we look at our cycle analysis and the bias of the market, we are anticipating this market to continue to push up for another week and a half or so. And then from there, we'll gauge how that is going to unfold. Now, overall, we have the market potentially running up into resistance, into the support low, these highs. And we could see it get up into this area. And then from there, we'll just have to see how the market looks health-wise. Is it a strong rally or is it just a bounce? And kind of go from there. We have short-term cycles. You can see a bunch of them topping in about 10 days or so. We do have longer term cycles putting in a bottom, several of them. So this market could drag out over a longer period of time and put a much longer sideways pattern, but we'll have to just, again, take it one bar at a time. We'll follow the trends and go from there. Now, the interesting thing I think that stands out today, and I do want to touch on a couple real estate charts also that I found very interesting and align with what I've been talking about and feeling and seeing unfold behind the scenes for a long time. But let's just start off here with right now we are seeing money. The stock market has been ripping higher over the past week and a half. Money has been moving out of the boring defensive sectors. Utilities fell out of bed there yesterday, really selling off, giving back pretty much all their gains over the past couple of weeks. So people moving away from defensive utilities. Consumer staples, same thing, moving down, going the opposite direction. While the stock market was falling before, we saw these defensive sectors hold their value or move higher, but now they're going the opposite direction. Nobody wants toothpaste and toilet paper. If we look at the healthcare, no matter what, we still need our healthcare, and of course, it's really been trading sideways and gave a good chunk of its gains there yesterday as well. And last but not least, boring kind of big blue chip dividend stocks continued to move down almost 1% yesterday, and they're really struggling. What's interesting is if we take a look at the dividend stocks are down about 8.2% from the highs. The SP 500 is down a little less than that. So the dividend stocks, again, definitely carry more risk and a lot more risk than people think. And they're definitely underperforming. The SP 500 recently sold off and is having a bounce. Whereas we look at the dividend stocks, they broke down a long time ago, and they are putting in what looks to be a fairly bearish pattern that may end up unwinding even more. Again, I think there's a lot of downside. 40-50+% in the dividend space, which is going to kill retirement accounts. We've talked about that many times, so I won't go into detail there. Gold continues to hold its ground. It has rallied up to that 3,050 to 3,060 range, and now it is pulling back, taking a bit of a breather. The next stop is about 3,200 to the upside. So we have another potential leg to the upside. Again, it keeps hitting our targets, taking a pause, and then running up and hitting the next target. Gold continues to be favorable. Again, if you're going to play the precious metal space, I like physical gold the best. If not, then it comes down to GDX, which are the large cap gold miners. They move closest to gold. They're the most reliable. And then, of course, you get into the more volatile and craziness with the gold miner juniors and silver miners and silver juniors, which silver juniors and silver stocks are underperforming dramatically, nowhere near the highs from last year. And they're really kind of underperforming. So again, the precious metal space is good for the physical long-term investor who wants gold and low volatility. Silver and silver miners are struggling and way off the highs simply because they're a speculative play. They're not the same investors who are trading. The reason gold's moving up is because the whole world is nervous and they want to protect their capital, whereas silver and silver miners are for people who are looking to make money. And we're not really in that phase of just easy big returns in the precious metals space, in all precious metals. That time will come, I think, late this year, early next year, when miners and silver will be kind of the play. Jumping forward to, let's take a look at real estate real quick. If we take a look at real estate, some interesting charts. So in the South, especially like Florida area, we have hit record highs since 2000, record highs from the last bubble of how many homes, single family homes, are for sale. There is a flood of homes. Everyone was building, and subdivisions. All that stuff is available, and now we're above the 2006 market top in that market, and it looks like it's showing some signs of volatility with some of these recent sharp pops and drops, which I would say feels something similar to over here. So this is not a good sign for real estate, obviously, with what's going on, and Trump talking about Canada. Well, you look south and there are millions of Canadians, snowbirds, that go to Florida who own homes and condos there, and a lot of them are bailing and they don't want anything to do with the United States. They're selling their homes. And now we got this influx of all these developers thinking they're going to make easy money building homes. They're dumping these new houses on the market. Nobody wants to buy. There's fewer buyers, and there's a lot of people wanting to put their homes up for sale, and now there's new homes in the market. So not a good sign for Southern real estate. Take a look at this too. This is single-family homes, all stages of constructions. This is the sales. Obviously, we have very low sales. So you go back to 2005, 2006, we had tons of sales. Lots of homes, but lots of them were selling. It was a feeding frenzy. Now we have lots of homes and things aren't selling. We just don't have any interest. This is a drop and a pause, which points to another drop, which means sales are probably going to slow potentially until prices drop. When prices drop, then we'll start to see sales pick up, but that doesn't mean home prices will go up. It just means there's a lot more sales because homes are falling in price and people are trying to pick up at a bargain. And the other side of this here is the average price, 6-month and monthly price of homes in the United States, new single-family homes. They continue to kind of flatline and fade, and the market bottom, I believe, is about to fall out. Homes aren't selling, people are lowering their pricing, and their homes still aren't selling. And that is going to be a rude wake-up call for a lot of people that once this starts to break down and fall, it's going to create a precipitous wipeout, and we could see a fairly big drop in real estate. Based on my math and expectations, I see the market dropping down down to around 360, which would coincide to about a 16 to 17% drop in home values from where they are right now. So a pretty big potential drop in the real estate space, I think, is pending. Anyways, that's it for now. The markets, again, just letting them work themselves out. Cycles are kind of pointing us to higher and sideways pricing. And we're just letting this market work itself out to see if this is the start of a rally and we potentially get a new buy signal and maybe ride the markets higher, or the market rolls over, continues to be weak, and maybe we have an opportunity somewhere else. Bonds may come to life. They're not there yet, but we'll just take it, again, one bar at a time. Take care. Bye-bye.